The Firm, India's only show on corporate law, tax and audit matters.
Hello and welcome to The Firm. On the show this week is the new startup listing platform, India's version of the Nasdaq. Will Made in India startups stay in India? And India Inc. has two new secretarial standards to comply with. Are they useful or painful? Genpact, WNS, MakeMyTrip.com. I think since 1999, only 3 India-based companies have listed IPOs in the US. Singapore has half a dozen India listings, but I think they're all REITs. Last year, the Singapore Exchange set up a Mumbai office to woo Indian companies. London boasts of more than 70 Indian companies listed on the LSE and AIMS. Now, together, the numbers may not speak of an exodus, but there is the fear that this new wave of Indian startups, the Snapdeals, the Olas, the Zomatos, when they're ready to go public, will go public in New York, London or Singapore. More so because new regulations dating last year allow Indian unlisted companies to list depository receipts abroad. Now, this has prompted SEBI to devise a new startup capital raising and listing platform. So, will Made in India ventures stay in India? Aayush Ailawadi finds out.
In 2010, MakeMyTrip, one of India's leading online travel companies, listed on the Nasdaq. It raised $70 million in the IPO, and on day one, the stock doubled in value. MakeMyTrip founder Deep Kalra says that he picked Wall Street over Dalal Street because back then, the Indian market wasn't ready to accept internet businesses.
We actually had the opportunity to list in India through the book building process in 2010 when we evaluated. We looked at both options very carefully. We were profit making, so we had that opportunity as well. The reason we went, actually Nasdaq is secondary, the reason we chose to list in the US was primarily because of the depth of online companies, both US and international, who had already listed there. So there was a very large number of investors who understood the online model, and for us it made sense to go there.
Lawyer and former SEBI legal chief Sandeep Parekh says that a foreign listing brings prestige and better valuations.
The Indian markets are reasonably deep, but valuations have, of course, as you know, last 5 years they've been quite poorly valued, so that could be one reason why people would still want to go abroad. Flipkart, for instance, may be valued at $20 billion in the Western markets, but only, let's say, $5 billion in the Indian market.
Nasdaq has for long been the preferred exchange for technology and new age companies. Microsoft, Apple, Google, Amazon, Facebook, they're all listed on the Nasdaq. But the NYSE is catching up. Last year, Chinese e-commerce company Alibaba listed on the NYSE after doing the largest IPO in history. The question is, will Flipkart, Snapdeal, Ola and Paytm follow suit, or can India keep them back? It's a question that Praveen Chakravarti and his colleagues at SEBI's Primary Market Advisory Committee have been trying to answer for the past few months. Praveen's played entrepreneur, venture capitalist and investment banker. He points out that in the last 8 years, nearly 3,000 Indian startups have raised more than $60 billion in venture capital.
Let's look at the numbers. There was 60,000 crores that went into new small and private companies by venture capital firms in 2014. In the last 5 years combined, the IPO markets have generated 50,000 crores. One Ola Cabs has raised more venture capital, which is a 2-year-old company, has raised more money through a venture capital, foreign venture capital, than the entire IPO markets put together in the last 3 years.
But Ola and gang would find it tough to go public on India's main boards because SEBI's current IPO rules, including the need for a profit track record, restricted fundraising purpose, extensive disclosures and traditional valuation methods are not suited to startups, especially technology and internet-based companies.
So we have made a very special provision for these startups.
Based on the committee's deliberations, SEBI recently announced the creation of a new platform for startups to raise capital and list.
I'm hoping that this would be very attractive for some of these startup companies as well as for the venture capital and private equity investors to have their portfolio companies listed, because the other side of that argument is there are 1,565 companies in India today that have private equity and venture capitalists for more than 5 years. Typically, I call it the 5-year itch. The venture capital and private equity investors that have invested in these companies, after 5 years, start to think about how do we exit and make returns. There has been a bottleneck when it comes to exits for these people. And this is a very important asset class. So it was also from that perspective, we will have to see if this could be a good exit platform by having some of these companies list on this platform that can generate returns for these investors, which can then go back into funding newer companies.
There's no doubt that India's startup community is enthused by this new platform. It has several good features, but also an odd bias and an unchanged burden of paperwork. But let's start with the good stuff. A minimum 200 investors, each investing a minimum 10 lakh rupees. In the size of companies it will attract, this new startup platform ranks somewhere between the existing SME exchanges and the main boards. And to appeal to its target audience, the platform plays it cool with rules. No need for a promoter. In fact, no shareholder should own more than 25%. No cap on the money raised for general corporate purposes. The IPO pricing need not be based on traditional valuation methods. And the post-issue lock-in period is a mere 6 months. Investment banker Gesu Kaushal gives this platform a big thumbs up.
I think the 2 points that this platform seeks to address or solves for is that a lot of these companies don't really have promoters who hold sizable shares in the company. So promoters have over a period of time been diluted significantly. Under our traditional ICDR regulations, it is required that a promoter holds and locks in 20% of its post-issue capital for 3 years. In a lot of these companies in the new age or startup sector do not have that kind of holding. So ITP addresses that problem. The second problem it addresses is tangible use of proceeds, which is traditionally required for a brick and mortar company in India. And we've kind of been reading about it, that most of these companies, the startups, the tech-enabled companies, do not have very concrete or tangible use of proceeds. A lot of their use of proceeds is advertising or discounts, etc.
I think it's a good development because it will allow these companies to raise funds for general corporate purposes, 100% of it, which means they can blow it up, as they call it, burn the money on advertisements and daily kind of paying salaries and stuff like that, which is not permissible for. Usually you need a project, you need to kind of allocate, this is how you're going to spend the money, etc. So I think it's a huge liberalization from that perspective.
This perhaps is the first time in the country's history that we're moving away from the concept of a promoter. We've always thought of a company, and then especially during listing time, as a promoter-owned company. Who is the promoter is the big question. Now we can say that a startup or a new company has a founder, but not a promoter in terms of equity ownership. So if you and we needed to enable that.
Oddly, the new platform leans in favor of technology-intensive companies. Earlier, SEBI planned to exclude non-tech startups altogether. It has dropped that idea, but not the bias. So, if Snapdeal were to list on this platform, at least 25% of its pre-issue capital must be held by qualified institutional buyers or QIBs. But for non-tech companies, say Paperboat, at least 50% of the pre-issue capital must be held by QIBs.
I think this discrepancy is somewhat silly, but I think the origin probably comes from the fact that the original ITP platform, this platform was supposed to be only for startups and technology startups. So from that, a lot of people gave comments, including us, saying that why should you have preference for certain classes of companies? So they seem to have relaxed that, but they seem to have still stuck to their guns, giving preferential treatment to particular types of startups, which is essentially technology-oriented, biotechnology-oriented startups.
Tech or non-tech company, there's no relief from paperwork. All startups will have to file a draft prospectus with SEBI for approval. And while there's the promise of fewer post-IPO disclosures, it's not on paper.
So based on the press release, it's very clear there has been actually no relaxation at all whatsoever in terms of quality of disclosure, in terms of frequency of disclosure, or in terms of relaxation with respect to clause 49, the corporate governance norms. So there's a small relaxation with respect to material and non-material. So certain non-material disclosures go to the website instead of the prospectus. But I don't think the prospectus is going to look any different from a regular prospectus at all.
What are the long lead items in any IPO? This whole thing about promoter disclosures, group company disclosures, use of proceeds, some of these will get addressed when the final print comes, I think. And other than that, investors do need to know the business of the company. They need to see the financial performance of the company. They need to, see how the capital structure has been built up. So some of those, I think, are important disclosures that are required for investors in any case.
Post-listing, once you're listed, if the markets are functioning effectively once you're listed, then the post-listing requirement should hold good for all companies. So which is, they have to adhere to the listing agreements and quarterly reporting and all of those, which I think was hygienic, good corporate behavior, and it's worked well across. So there was no need to tamper with that.
In the 3 years since they launched, the BSE and NSE SME exchanges together have just over 100 companies. These exchanges require compulsory market making for every listing for a minimum of 3 years. The new startup exchange does not feature this yet.
So the most important requirement is liquidity. And how does liquidity happen? Liquidity will happen if you enable market making by merchant bankers. Merchant bankers today are not allowed to make markets, to indulge in market making on the main board. Now, I think my suggestion definitely would be to make market making, or at least allow market making in this segment. And second, for startups and boards of companies that are choosing merchant bankers, choose a banker that will help make markets in the stock. It's only then liquidity will get generated, and it's almost universally known that in the initial period, 15 days, 30 days, there will be a lot of market making requirement, and only then this will succeed. So to me, that is a very key requirement. I was disappointed that it was not addressed directly. Perhaps it will come in the regulations, but that will be very crucial.
You have SMEs, which is a segment again which is meant for sophisticated investors, because the smaller the company, the more sophisticated the investors you need, because the risk is much higher. And the third is, of course, this new platform which is meant for these companies. Ultimately, I think there will be fragmentation of markets. You have 3 markets, which is not an ideal scenario. What I would want, my wish list would be that these two get merged into the main board, and you keep the trading lot at 5 lakhs or 10 lakh rupees, which would automatically exclude the smallest of the retail people who could burn their fingers through either in the SME platform or with, let's say, e-commerce companies.
India is experiencing a startup frenzy like never before. That's why SEBI has identified a list of 20 young companies, each valued at over $1 billion. And this platform is meant to keep such companies in India. This could be India's answer to China's new Strategic Emerging Industries Board or Singapore's Catalyst platform. But an Indian Nasdaq still seems like a distant dream. In Mumbai, Aayush Ailawadi.
While we're awaiting regulations to spell out exactly how this new startup platform will work. On that note, let's take a quick break on the firm. Coming up next, India Inc. has 2 new secretarial standards to comply with. Are they useful or painful?